Welcome back to the Harry Levine Insurance YouTube channel. Today, we're going to be talking about different types of insurance policies in the Florida homeowners insurance market. Remember, all insurance policies are in fact legal contracts, and all insurance policies are in fact different. Let's get into some of that uniqueness. Car insurance is largely equivalent amongst states, but there are some nuances. Florida, for instance, is one of the last states that still employs a no-fault system. We call it personal injury protection, or PIP, and that's really what sets apart a Florida auto policy from, say, a Georgia or an Alabama. So PIP, again, effectively is no-fault, which means that for up to the first $10,000 in any loss, 80% of which can be for medical expenses and 20% of which can be for lost wages for time out of work, it provides coverage no matter who's at fault. So let's say you get in an accident and it's your fault. PIP is the first coverage to trigger. Let's say you get in that same or similar accident and it's the other party's fault. PIP is still the first coverage to trigger. Effectively, it's the state requiring you to have a certain very minimal amount of insurance that will be there no matter what. It's not dependent on the third party having enough insurance, which unfortunately provides a false sense of security, and PIP is also a leading driver when it comes to fraud and increased insurance costs in Florida. You don't assume that the least amount of coverage is the least amount of premium. You've got to get the word cheap out of your mind, and despite the fact that even we here at Harry Levine Insurance sell product for and have a fabulous relationship with that company that constantly shows you commercials with the nice lady taking the insurance package off the shelf and handing it to the consumer, that's not really what insurance is. Insurance is a legal contract that's highly customizable, and what you really need to do is get with an insurance agent with whom you have a relationship and that you trust. And then you need to look at the specifics of your household and your risk. Only then can you design the proper custom contract for you. So you've got to get that cheap word out of your mind. What you need to think about is getting the best coverage you can that fits within your budget. But coverage first with a keen eye to your budget. Calling home insurance in Florida unique is sort of you're opening a Pandora's box. Florida has become, by and large, the black sheep in the United States when it comes to property insurance. First of all, most Florida homeowners insurance companies are what we call domestic insurers. That means that they're not national players. At best, they're regional, and most commonly, they only do business within the borders of our great state. Next, there's an organization called ISO that writes template forms that most insurers use for their policy contracts. Florida is famous for either just not using ISO forms, which are commonly used across the rest of the country, or for using ISO forms but then adding endorsements which change the terms of the contract itself. So you'll see an ISO policy and then it will have something called a Florida-specific term or Florida-specific endorsement, which then takes that generic language that we see all over the country and completely chops it up and changes it. So Florida is faced with a number of unique challenges, but here's the kicker. They're not sinkhole, they're not hurricanes, and they're not any of the other natural disaster type items that we hear about. In fact, the biggest challenge to the Florida insurance marketplace, specific to property insurance, is actually our regulatory environment. The Florida legislature, that means the Florida House and the Florida Senate, those folks we send up to Tallahassee for a few months each spring, have created a situation where we are a breeding ground for fraud. We do not have much needed tort reform, and premiums will continue to rise because of the legislature's inability to act. What it boils down to, the Department of Financial Services, which ultimately oversees the Office of Insurance Regulation, and the Florida Insurance Commissioner, and the Florida House of Representatives are typically supportive of common sense insurance tort reform. What happens though is once bills are supported and passed in the lower chamber, they go to the state Senate. And the state Senate is overwhelmingly controlled and influenced by the trial bar and its lobbying arms. Therefore, whenever we get common sense reform that could bring premium relief to you, the consumer, our state representatives tend to kill it and refuse to let it go through to all of our benefit. And when I say all of our benefit, I talk about myself both as a consumer and as an agent. My job is to be able to develop relationships and match appropriate products within the desired budget level to you, the consumer. The more our state Senate refuses to act, the more I'm unable to do that job. And likewise, as a homeowner, the more I suffer right alongside you as a consumer. Homeowners need to be engaging their local elected representatives. And when I say local, I mean your state level. So find out. Go to myfloridahouse.gov. Look up who your state representative and who your state senator are. Then email them, write them a letter, call them, meet them for coffee in district. They actually do want to speak with their constituents. I know it for a fact, and I'm proud to be involved in a grassroots level with my local representatives. It's not a settlement that maybe the insurance company adjuster could have looked at differently, maybe it was handled right, maybe it was handled wrong, but it needed to go to litigation, the court system got involved, and there was a monetary settlement. That's not what's driving these costs. It's that behind the scenes in those cases, there are sometimes as much as $750,000 in attorney fees that the insurance company must pay, the other party's attorney fees, not their attorneys defending them, to then arrive at as little as a $20,000 settlement for you, the consumer. It's a broken system, and you can fix it by contacting your state representative and your state senator. Traditionally, Tri-County, which is represented by Palm Beach, Broward, and Miami-Dade, have had a very, very restricted marketplace, meaning there are only a few companies writing business that typically has diminished coverage for vastly inflated premiums. We now talk about Central Florida along the I-4 corridor as SOLO, Seminole, Orange Lake, and Osceola counties. We're facing the same problem as Tri-County now. We're down to where a year ago, we might have as many as 24 companies willing to offer a quote if you're looking for insurance, to where now it might be 5 or fewer. Additionally, coverage restrictions are routinely in place, and we are seeing, on average, premium increases of between 30 and 50% over the last 12 to 18 months. So what that means is make sure that you choose an agent wisely. You want someone that works with a ton of carriers, but the idea is not to shop your insurance once a year. The idea is to know that you're with an agent that can strategically move you and has access to all of the best markets in the state. So if and when it's right to make a move, that agent's able to counsel you through that process. As for now, unfortunately, we're all gonna have to bite the bullet and put up with premium increases. The scariest thing about all of this to me as an agent is that sometimes, sure, there's a company or two out there that you can find a cheaper premium with. The problem is, again, all insurance is not created equal. And when you have a less expensive contract, you are truly, more than likely, going to be giving up coverage. And when that claim happens is when you're gonna suffer from that. Your pocketbook might feel an advantage today, but if a hurricane comes through, or God forbid you have a kitchen fire, or whatever might occur, if that coverage is limited or missing when you need it, it's a recipe for disaster. Created equal. And when you have a less expensive contract, you are truly, more than likely, going to be giving up coverage. And when that claim happens is when you're going to suffer from that. Your pocketbook might feel an advantage today, but if a hurricane comes through, or God forbid you have a kitchen fire, or whatever might occur, if that coverage is limited or missing when you need it, it's a recipe for disaster. It boils down to understand your policy. It's boring, it's written in legalese, it's usually somewhere between 40 and 80 pages or even more. But you need to understand the contract, not just the declarations page. The declarations page, which is where you see your nuts and bolts coverages, your dwelling amount, your other structures, your personal liability, your personal property, that's all good to understand. However, it's critical that you understand the limitations in your contract. Every insurance policy has exclusions and has limitations. And we see a lot of things now in Florida homeowners policies, like water coverage limitations, which could play in, or animal liability limitations. The water limitation, depending upon your policy language, could actually limit recovery for a loss to something like only $10,000, even if you had a $100,000 loss. That was attributable to water. The most common situation there is a broken pipe. Unfortunately, we're again in an environment that's riddled with fraud. Let's say we have a true water was the proximate cause loss, and that could happen during a hurricane event, depending upon the specifics, even though overarching, it's going to be windstorm more often than not, but everything's adjusted differently, circumstances are different. If you have limitations like that, you could literally be left high and dry with only a portion of a loss being covered. And unfortunately, a lot of people tend not to look at documents they receive from their insurance company. And a lot of times when a home reaches a certain age, the company will send you a change in policy terms. I'm thinking of one company in specific, I won't name them right now, but they do this. Your house reaches 30 years old and you get a letter in the mail with a bunch of legalese and additions, addendums to your contracts, endorsements we call them in the insurance world, and it basically takes away your water coverage. So that fridge ice maker line breaks and floods your kitchen for 7 or 8 hours until you get home from work and causes 30 grand in damage. All your drywall's being redone, you need new carpet, etc., etc. Your stove shorted out, whatever the case may be, it's uncovered. And it may have been covered on your policy last year, but that insurance company followed the law, followed how they're regulated, mailed you a change in policy terms. You received it and you filed it. That's why I go back to the beginning. Understand your policy. Call your agent. And the first thing shouldn't be, get me a cheaper policy, I want you to shop. The first thing should be, I'd like to review my current policy and I'd like to understand it because I think I might want to look elsewhere. But the thing is, I want to make sure that I'm covered properly. And it's the old adage about being penny wise and dollar foolish. It's really about understanding the value in your insurance contract and understanding that if you look at 3 different insurance companies, there's no such thing as apples to apples in this game, guys. No such thing. In this industry, every insurance company has a unique contract, particularly here in the state of Florida, as we just discussed. Even if they're using those ISO forms that are templates that are used widely across the rest of the United States, because of our legislative and regulatory environment, I'll say it again, legislative and regulatory, not sinkholes and hurricanes and lightning strikes and things like that happen all the time in Florida. We have a very unique set of insurance carrier contracts out there, and no two are alike. And unfortunately, you as a consumer need to become an amateur expert, and you need to have a professional expert in the form of an independent insurance agent who can truly be on your team when it comes to understanding that coverage and those contracts. First of all, make sure your policy has windstorm. Most do, but there are folks out there who would sell you a policy without it because it's cheaper. And also there are certain areas of the state where you may find yourself in what we call the wind pool, in which case you might have to buy what's called an X-wind or a multi-peril policy and then a wind-only policy. That situation typically only occurs if you're located on a barrier island, although there are a few exceptions. In short, you want to make sure that you have windstorm protection, and you just want to be aware of what your deductible is. There are a few companies, not many, who still offer a more traditional deductible such as $500, $1,000, $2,500, or $5,000 for windstorm. What's become the norm though is a percentage-based deductible. So you may see a 2, 3, or 5% hurricane deductible, named storm deductible, or wind and hail deductible, which are all different things by the way, and we can get into that at some point. However, what that percentage is a percentage of your dwelling coverage, your coverage A. So let's say your house is insured for $100,000 to use a nice round number. A 2% deductible means that your deductible would be $2,000 or 2% of $100,000. Likewise, 3% would be $3,000, 5% would be $5,000. But again, what you need to know is, do you have a hurricane or named storm deductible, which basically means if the storm has a name, so it can be a tropical storm too. But if you're talking about, tropical storm or Hurricane Craig, that percentage deductible or that stated hurricane or named storm deductible is what's going to apply. If you have a wind and hail deductible, and there are a few companies that do this on homeowners insurance, and most do it on the commercial line side of the house, business insurance, wind and hail literally means wind and hail. So that percentage-based deductible applies whether it's a named hurricane or it's a strong afternoon thunderstorm. That is something to watch out for, because your cheap homeowners policy may very well have a wind and hail deductible, which means that you may be looking at a $10,000 deductible depending upon the value of your home instead of that $1,000 deductible, even if it's just a tree branch from an afternoon thunderstorm and gust of wind that damaged your roof. Flood is its own world, and the National Flood Insurance Program, or NFIP, is administered by FEMA, which is our Federal Emergency Management Agency. So, long story short, flood insurance is a whole nother ballgame. Ask your agent about it. We're happy to consult anytime. It's usually very inexpensive unless you're in a high-risk zone. However, water damage is likely covered by your multi-peril or your windstorm hurricane coverage that's part of your normal homeowner's policy. It's all about a thing called proximate cause, which means what started the whole issue. So let's say a tree branch puts a hole in your roof or flies through a window, creates an opening, and now driving rain's coming through that opening. Water damage like that is of course covered. Flood has a definition as provided by FEMA. It's a little bit complicated. We can do a whole segment on it at some point, and I hope you'll watch. This is why you should subscribe. And long story short, flood, again, is its own world. But water damage that is caused during a windstorm event is very typically covered by your normal homeowner's insurance, provided you have windstorm coverage, because if that windstorm is the proximate cause or what started the whole chain of events, then that is what's considered the covered peril or the covered cause of loss. Boat is a much more, dare I say, simple product until you get into very high value yachts and mega ships, if you will. But your typical recreational boater's policy, someone's got a bass boat or a 20-foot ski boat or something like that. There are contractual differences. You still need to understand them. But it's much more like the auto insurance realm, where you've got a very, very typical set of nuts and bolts that, again, you need to navigate with your agent. But there really aren't as many traps as there are in the homeowner situation here in our state. Buy a standalone policy for your RV, for your motorcycle, for your boat with an engine that has 50 horsepower or less. They're very often, again, in Florida, it's hit or miss because we don't use standard ISO contracts. But they're very often, particularly amongst the national carriers that are still writing here, coverage extensions for things like a boat with an engine under 50 horsepower on your homeowner's insurance. It's a trap, guys. Don't do it. It's a trap. And the reason is, if you have to have a boat claim, why would you risk putting that claim on your homeowner's insurance and affecting either rate and or finding yourself in a situation where you're being non-renewed? As well, they're often value-added throw-ins, which means they're not to any kind of full or proper coverage limit. So you might have a little bit of coverage, but again, it's going to be limited. So you're like, oh great, my boat's covered on my homeowners. The truth is, there's something there, but it's probably not enough, and it's probably very limited. So again, if you go, very inexpensively, mind you, for an RV or a boat policy, to speak specifically to the question, I mentioned motorcycles, that's a whole nother ballgame, truly. But your boat, your RV, your golf cart, don't rely on your homeowners. For a couple of $100 a year, very often when I say a couple of hundred, I truly mean like maybe 200. It's just worth the proper level of protection. This is why I also recommend that people do not schedule their jewelry or collectible items to their homeowner's policy. So let's say you take a vacation, you live here in Orlando, you're up in New York, once that place can be visited again, and you lose your diamond ring. You now have a potentially very expensive claim that if it's scheduled on your homeowner's insurance, which there's nothing wrong with that, but now that claim is a homeowner's claim. And your homeowner's company is gonna go, oh wow, these people lost us 25 grand last year. Maybe we're not gonna offer them a renewal. And now you're scrambling in the last 2 or 3 months before your renewal to find replacement coverage. Oh, and when you go to a new company, and they pull your loss underwriting report, that $25,000 claim shows for them as well. So they're now thinking, do I want to take on this risk? That's why I always recommend a separate jewelry policy, which there are plenty of options to obtain, that is separate from that homeowner's. You're keeping each thing in its own separate box. It's the same thing with that golf cart, with that boat, with that, whatever recreational toy. Why risk your homeowner's policy when for literally beans, you can have more extensive, higher limit, better and separate coverage for those things? There's almost a mental shift that has to happen. And sometimes it sounds a little crass, but if you're lucky enough to have the problem of trying to figure out how to insure a toy like that, then you can probably afford a couple of extra bucks to protect them and ultimately your assets properly. What it comes down to is, what's the cost of replacing that boat if it gets damaged or ruined? What's the cost of litigation if you hurt somebody while operating that boat or that golf cart? My neighbor, their 4-year-old at the time daughter was run over accidentally by another child driving a golf cart, a young teenager in our neighborhood, and suffered a broken leg. And these things happen, and you want to make sure that you have proper insurance for a lot of reasons. One could be so that you're not in a situation where you're at war and suing somebody. Another could be, God forbid this happened amongst groups of people that were friends, everyone can shake hands at the end of the day, and you're not fighting over money. It can go either way, but the bottom line is you want to be prepared for that bad event. And if you're not properly prepared for that bad event, that's when you're opening up your personal relationships and your assets, your finances, your life savings to a litigious problem. Well, that's a wrap, folks. I'd like to thank you for spending a few moments with us and remind you that we've got some great content coming up next. Stay tuned.